Welcome to The Explainer. Today, we're going to talk about a pretty radical idea, one that could totally change how we think about investing. I mean, forget stocks, forget real estate for a second. What if you could build a portfolio of people? Yeah, you heard me right. What if you could invest directly in your favorite YouTube channels and actually own a piece of their content and future earnings? I know, it sounds pretty wild, but we're going to treat this as a serious financial question. Can a YouTube channel built all around one person's personality really be considered an investable asset? We're going to dig deep into the fundamentals and see if these new age media businesses really have what it takes to, stand next to the big giants on Wall Street. So here's our game plan for today. First up, we'll look at this whole creator economy gold rush. Then we're going to get under the hood of a YouTuber's business and really see if it's built to last. After that, we get to the tough stuff. How in the world do you put a price tag on a YouTube channel? What are the risks hiding in plain sight? And then we'll wrap up by looking at what the future of investing in this new media world could actually look like. All right, let's jump right into section 1. To really get a handle on this new world of investing, you have to make a pretty big mental shift. You've got to stop thinking like a viewer and start thinking like an owner. And that all starts with, the most basic idea in all of finance. We all know this definition, right? An asset puts money in your pocket. A liability takes money out. So the big question for us today is this. Is a YouTube channel just a hobby? A liability that just sucks up time and money for cameras and software? Or is it a true asset, a business engine that churns out cash flow long after the creator has turned the camera off? We're not talking about vanity metrics here like subs or views. We're talking about pure hard profit. Okay, so let's say you're on board. You agree a channel can be an asset. So how do you get in on the action? Well, it really comes down to two things. First, the obvious one, you need the cash, the capital. But honestly, the more important thing is financial education. You need the smarts to tell a real opportunity from just a bad bet. And for this new kind of asset, that's way more than just reading a stock chart. It means you have to understand demographics, content trends, the risks of the platform itself, and the strength of the brand. If you don't have the knowledge to analyze the actual business, you're not investing. You're just gambling on a personality. And that brings us right to the heart of it all. Does a YouTuber setup actually look and feel like a scalable business? The kind an investor would actually want to own a piece of? Let's break down the business model and see if it really holds up. When you think about the ideal business model, it's kind of crazy how perfectly a lot of top YouTube channels fit the bill. I mean, think about it. The overhead is incredibly low. There's no factory, no storefront, just maybe a home office. They often don't have full-time staff, just a team of freelance editors and managers. There's zero physical inventory to stress about. And this is the best part. Their whole library of old videos acts like a portfolio of little mini assets, generating ad revenue and affiliate income 24/7, literally while they sleep. This really gets to the holy grail for any entrepreneur. And this quote just nails it. The ultimate goal is to separate your time from your income. A freelance video editor, for example, gets paid for the hours they put in. If they stop working, the money stops coming. Simple. But a successful creator, they build an asset library. A video they made 3 years ago can still be getting views, still driving sales, and still earning them money today. That is the huge leap from just being self-employed to owning a truly scalable and, investable business. Okay, so we've laid out the theory, but how does this all work in the real world? This is where the rubber really meets the road, trying to value something that feels intangible. How do you apply cold, hard numbers to a business that's built on personality and creativity? Well, let's run through a little hypothetical to see exactly how an investor would tackle this. Okay, picture this. You're an investor, and you've got a choice. You can buy a piece of one of 3 different YouTubers. Now, they're all in the same niche, they're all making the same amount of money, and they all have the same number of shares out there. On the surface, they look completely identical as investments. But are they really? Let's take a look at the books. This chart right here shows how one simple accounting choice can tell you basically everything you need to know. Just look at YouTuber B versus YouTuber C. They spent the exact same amount on a computer, but YouTuber B is depreciating that asset over 5 years, which is just them admitting, hey, this thing will lose value and I'll have to replace it. YouTuber C isn't. And that one little choice means B is showing a real picture of their long-term profits, while C is just artificially pumping up their numbers by ignoring a very real future expense. To an investor, YouTuber C looks either totally clueless or, worse,
dishonest.
So this is like the investor's first pass checklist. First, you look at the real tangible assets. What's that computer actually worth if you had to sell it on eBay tomorrow? Second, you hunt for weakness. That accounting trick from YouTuber C, that's a huge red flag that makes you wonder what other problems are hiding under the surface. And third, you have to limit your downside. If this whole channel just goes up in smoke, what can you get back? Hey, even selling a used computer is better than losing everything. This kind of basic analysis is how you start weeding out the weakest links. You know, this quote, as blunt as it is, it perfectly captures the investor's mindset. Just because a channel looks good on the outside, tons of subs, flashy videos, that doesn't mean you commit. You have to do your homework. You've got to look past the pretty surface and analyze the financial reality underneath before you even think about, putting a ring on it, financially speaking. Okay, so we've talked a lot about the potential upside, but every single smart investor knows you make your real money by managing the downside. So now we have to talk about the hidden risks. And believe me, in the world of online financial content, those risks are massive. And legally, they're a total minefield. We've all heard it a million times, right? That little mantra. This is not financial advice, usually mumbled real quick at the start of a video. But here is the multi-million-dollar question. Does that phrase actually protect them from anything legally? Or are these creators just operating in this huge legal gray area, totally exposed to a lawsuit that could bankrupt their entire business? Well, legally, it's murky. On one hand, creators might be covered by something called the publisher's exemption. This is for general stuff, like a newspaper, and that probably works for a lot of YouTubers who are just giving broad commentary on the market. But the teacher's exemption, that's a way tougher sell. That was designed for actual teachers, where giving advice is just a small part of their job. If your whole business model, your entire channel, is built on giving out financial content, you start to look a lot less like a teacher and a whole lot more like an unlicensed financial advisor. And regulators do not like that. Here's the fundamental problem, right? The laws we have were written for paper newsletters, not for TikToks and YouTube videos. The legal system just hasn't caught up with the speed and the scale of all this new media. Now, this creates what people call a viewer beware market. And that's true. But for someone who wants to invest in a creator, this isn't just a risk. It's a ticking time bomb. One big lawsuit, one regulatory crackdown, and poof, your entire investment could be wiped out just like that. So where does that leave us? We've walked through the business model, how you might value one of these channels, and the pretty serious risks involved. If you're really looking at this new media world as an investment opportunity, what are the key things you absolutely have to keep in mind? Look, in the end, it all comes down to this. You have to separate the fan from the financier inside you. You have to think like an owner. That means you analyze the balance sheet, not the subscriber count. You dig into the business model and how they make money, not just read the comments section. And most importantly, you have to get that the risks in this space, legal risks, reputational risks, getting canceled, lawsuits, they are unlike anything you'll find in traditional investing. So it's not just viewer beware. For anyone putting real money down, it is absolutely investor beware. This whole new asset class, it's a wild frontier. It's filled with incredible opportunity, but also just immense risk. And as we see individual creators building these massive media empires basically from their bedrooms, it leaves us with one last big question. Who's going to be the first person to crack the code? Who is going to figure out how to properly value these things, how to acquire them, and how to scale a whole portfolio of these digital assets? To become the Warren Buffett of YouTube. Now that is the billion-dollar question.